At this point, we have computed all the individual components of market risk. In this section, we bring everything together into a single concise market risk report, expressed entirely in monetary terms. Each row in this table represents a different dimension of downside risk. The goal here is not to optimize any single metric, but to understand how different risk perspectives interact. The first two rows report value at risk at the 95% confidence level using two different approaches. We discussed them in detail in the previous chapters. The historical VaR is approximately minus 16,500, meaning that on a typical bad day, losses exceeded this level about 5% of the time. The parametric VaR, based on a normal distribution assumption, is slightly more conservative at around minus 17,200. These two numbers are close, which suggests that for moderate downside risk, the normal approximation is not wildly misleading. The third row reports the average loss in the worst 1% of days, which is approximately minus 44,000. This number is almost 3 times larger than the VaR estimates above it. This gap illustrates a key limitation of value at risk. It tells us where losses begin to get bad, but it tells us nothing about how bad they can get once that threshold is breached. The worst drawdown metric captures the largest peak to trough loss observed in the sample. In this case, the maximum drawdown is approximately minus 337,000. This is by far the largest number in the report, and that's not a coincidence. Drawdowns capture cumulative losses over time, which are often more damaging operationally and also psychologically than isolated daily shocks. The stress P&L row shows the portfolio loss under a hypothetical 5% market shock, which results in a loss of 50,000. This metric is intentionally simple and scenario-based as discussed. It provides an intuitive answer to the question, what happens to the portfolio if markets move sharply against us in a single day? Finally, the report includes the average loss across the 10 worst trading days, which is approximately minus 66,000. This metric sits between VaR and maximum drawdown, providing a realistic sense of severe but not catastrophic downside outcomes. The strength of this report lies in its structure. VaR captures typical downside risk. Tail loss captures severity beyond VaR. Stress testing captures scenario risk. Drawdowns capture persistence and cumulative impacts. No single metric tells the full story, but together they form a coherent picture of market risk. In practice, reports like this are used to support risk discussions rather than to produce a single correct number. The objective is to understand exposure, trade-offs, and potential failure modes under different conditions.